Welcome to CRE Newsroom. Today is Friday, 1st of May, 2026.
Yesterday, Whitbread confirmed a major shift in its property strategy, announcing plans to sell around £1.5 billion of Premier Inn freehold hotels over the next 5 years, while leasing them back from new owners. The move is framed as part of a broader 5-year plan to reduce capital expenditure, increase free cash flow, and return more value to shareholders. Whitbread currently owns freehold interests in roughly half of its Premier Inn estate. Under the new plan, that proportion is expected to fall to somewhere between 30% and 40%, meaning the operator will own a smaller but still substantial freehold core, rather than becoming fully asset-light. The transaction will be structured as a series of sale and leaseback deals on mainly Premier Inn hotel freeholds, to be executed over about 5 years, rather than rolled out in a single front-loaded tranche. Around 1/5 of the existing Premier Inn freehold portfolio is expected to be sold, with long-term leases put in place so that Premier Inn continues to operate at those sites as a tenant rather than a landlord.
Whitbread has signaled a clear reduction in capital outlay. The company is cutting its net capital expenditure plan by about £1 billion versus the previous 5-year framework, lowering ongoing annual capex to roughly £200 to £250 million. Those savings, combined with the anticipated proceeds of around £1.5 billion from the freehold sales, are meant to support a target of roughly £2 billion of free cash flow for shareholders by financial year 2031. CEO Dominic Paul has pointed to regulatory and tax headwinds as key catalysts. Rising business rates are expected to add around £35 million in costs this year, with the potential to reach roughly £110 million within 3 years, alongside higher employer national insurance contributions.
Before we move on to the next story, if you're finding this useful, please subscribe, like, and share this with someone else who follows the market. Your support really helps me continue producing these commercial real estate updates.
Blackstone-backed IQ Student Accommodation has successfully secured a major new debt facility, underscoring continued lender confidence in the UK's purpose-built student accommodation PBSA sector. The platform has finalized a £562 million senior refinancing package with the Japanese lender Mitsubishi UFJ Financial Group, MUFG. This transaction highlights the increasing appetite from Asian capital for stabilized, high-performing UK residential assets. The refinancing is secured against a portfolio of 9 PBSA assets located across the United Kingdom. The funding is specifically earmarked to support the refurbishment and modernization of over 3,600 student beds. The assets are situated in high-demand university cities, including Glasgow and Brighton, where supply-demand imbalances remain acute. The Japanese bank acted as both the bookrunner and mandated lead arranger for the facility.
Qatari DR has completed a £450 million refinancing for the Chancery Rosewood, its luxury hotel redevelopment of the former U.S. Embassy site at Grosvenor Square in Mayfair. The new facility is provided by a 4-bank club led by Doha Bank, Mashreq Corporate and Investment Banking Group, Standard Chartered, and United Overseas Bank, as part of a broader refinancing of the Grosvenor Square trophy asset. The Chancery Rosewood is a 144-key, 5-star luxury hotel and retail destination being developed on the historic site of the former U.S. Embassy at 30 Grosvenor Square. The project is being developed by Qatari DR, the real estate arm of Qatar's sovereign wealth fund, and operates under the Rosewood Hotel Group brand.
That's all for today's update. Thanks for watching, and I'll be back with more CRE and capital markets news in the next video.